Gina, great to have you. I want to talk about some of the Fed meeting minutes that we got this morning. They are this afternoon reiterating lower for longer, and yet some of the economic growth numbers look so good. You wonder if the equity markets would be prepared if the Fed has to move sooner. What do you think?
Yeah, so we've actually been doing a lot of work on this recently because, frankly, the macroeconomic data that we follow that tends to be most relevant for predicting moves in the equity market has been astonishingly good. So good that we're worried that the Fed may have to truly acknowledge how good it is before too long. Certainly, we didn't see that in the minutes today. They're still very committed to keeping policy very easy. They see growth as somewhat vulnerable. But frankly, things like the unemployment rate, which, obviously the employment conditions are one of the Fed's favorite indicators. The unemployment rate in just a year's time has recovered as much loss as it did in 4.5 years following the 2008-2009 recession. It's at levels it's at similar levels to levels at which the Fed started talking about tapering the balance sheet last cycle, and right before the Fed started to actually increase the short-term rate. So employment conditions are just one example of very, very strong macroeconomic data that the Fed is so far willing to ignore. We're just not sure how much longer they're going to be willing to do so.
Talk about financial conditions and how much of a cushion, if any, that gives the Fed in making their next policy steps.
Yeah, so this is another indicator we follow pretty carefully. We actually look at financial conditions, and we look at financial conditions stripping out the equity markets as a guide for what to expect or the supportive conditions for the equity market. And again, financial conditions are near all-time peak levels of easy. So the Fed has done their job. They've made financial conditions incredibly easy, very tolerable markets for taking risk. That's getting reflected in the equity market. The question now is, how much longer will they need to really support the macroeconomic outlook and financial conditions? You've got credit spreads near all-time tights, financial conditions at large, incredibly supportive. Obviously, the equity market up magnificently over the course of the last year, and economic growth broadly that's probably going to print close to double digits over the course of 2020. So it really begs, the question, does the Fed need to be so committed to such extraordinarily easy policy? At some point, they have to start backpedaling. Might they start backpedaling a little faster than the market is anticipating? I would suggest that's the primary risk to stocks is the Fed may start to acknowledge this extraordinarily strong environment that we're in.
But of course, in the Fed minutes, that didn't show it. And it seems as though really there's this commitment to inclusive growth. So ensuring that it's not just your general unemployment rate, but everyone. People have been left behind in previous down cycles who have helped, Gina. But I suppose what could prove to be the backpedal catalyst is any inflation. Any signs of that? Any worries for the bulls out there, you think?
I think we do have some signs of inflation being embedded in asset prices, at least. We've seen traditional leadership in the equity market has shifted toward more inflation-sensitive sectors like energy, materials, and away from the less deflation-sensitive segments of the market. We've seen certainly bond markets, inflation swaps starting to price in stronger inflation risk. Nothing terribly difficult, I would say. So far, we've got to have much stronger inflation before inflation becomes a risk. It really more, in terms of our view, is an outlook for growth that is very, very strong and, frankly, stronger than many believe across the spectrum of participants in the U.S. economy.